since 2013, right after I retired from PepsiCo. If you don't know what SCORE is, we are a national nonprofit organization that began back in 1964. First chapter was established in Dallas, Texas, and we currently have over 200 chapters in the US. So our forte is really to mentor small businesses. That could be existing businesses. If you want to start a business and you need some help, we do nonprofits as well as for-profits. And you can see by the big blue ball there that the SBA is telling us that clients that receive 3 hours at least of mentoring do a better, have more successful businesses. And that's basically 3 sessions, 3 hours. So next slide, please. Our mission is pretty simple. It's to support small businesses, and we provide a couple things. Number one, we provide free and confidential mentoring to small businesses and entrepreneurs. And two, we provide educational workshops and webinars like this on topics that small businesses can benefit by. Next slide, please. A lot of our this is a lot. This is what really helps is we have like over 8,000 volunteers and we serve 1,500 different communities. They're usually in the bigger cities, not always, but um, um, next slide, please. We do so all mentors sign a code of ethics every year that basically says that we cannot benefit in any way from our clients, um, and that that your information is confidential and protected by the U.S. government. Next slide, please. So our services are free, and they're free for three reasons. One is we're a resource partner of the SBA. That means that they refer them to clients to us, and we refer them to them. We have a lot of very generous local sponsors that help us locally. And obviously, the 8,000 volunteers that volunteer their time is very helpful as well. Next slide, please. These are our sponsors, our local sponsors. We got at the platinum level, we have the Hoover Foundation, Stark Community Foundation, Stark State College, the Akron Community Foundation, Key Bank, and at the gold level, we have Huntington Bank and the Calhoun Charitable Trust. Next slide, please. At the silver level, we have People's Bank, Welty Family Foundation, the Gertrude Orr Donor, I can't read that, Advised Fund, the Youngstown Foundation. Thanks for adding that, Gwen. And at the bronze level, we have Lerner Foundation, the Ripple Foundation, Consumers Bank, and the Munson Charitable Fund. Next slide, please. So this is our website. This is where you would go to number one to find the recording of this webinar. You would also use it if you want to find a mentor, which is very easy, or if you want to become a volunteer. If you've got a business background and you think that your experiences could help smaller businesses, we're always looking for volunteers. With that, I'm going to turn it over to Brian and Matt. Brian, it's all yours.
All right. Thanks a lot, Ed. Appreciate it. Appreciate the time to be here. This is my name, and I've also asked along Matt Zaylor from TurboTax and QuickBooks expert as well. He is a financial pro and expert accountant, and to answer some of our accounting questions for today. The fact that you all made time today to be here means a lot, and they carved out some time during your week puts you kind of ahead of the game. We've got a lot of information to cover today, and I promise it's going to be worth your while and put you in that top 1% of businesses that are actually on top of their finances, as this is a subject matter that a lot of people don't take the time to fully understand. The point of today is not to turn everybody into financial accountants and professionals, but really to understand what's going on beneath the surface of their business in order to make better financial decisions and to let their financials guide their business. And really lay things out in a practical way that everybody can understand. A little bit about myself. I've run a couple businesses and exited a couple businesses myself. I've had a marketing company that I ran in Bakersfield, California, before returning to Ohio and running a family vending business, which I built that up in 10 years' time and then exited that before going into more of my passion, which was in financial technologies and finance. Um, and then I got into banking. I've been in kind of a banking role and a banker role for over a decade. And now I'm the current treasurer for the Canton Akron SCORE chapter, as well as the owner of Transworld Business Advisors. Transworld Business Advisors of Canton is Northeast Ohio's trusted business exert partner that serves Stark and Columbiana counties for entrepreneurs that want confidential business brokerage, certified business valuations, looking for strategic exit planning. um, we specialize here in helping retired business owners to maximize value, preserve their legacies, do confidential transitions, perform certified business appraisals, and valuation, succession planning, business sales, and pursue acquisition opportunities. The reason that I share this is because through banking in my past history of running a small business where I was not the best at financial management, and I'll be the first to say so, and then going into banking and seeing what a banker looks at for lending opportunities, and then advising as a business advisor and the owner of a company that sees multiple of financials from business companies and sees companies that do things well and multiplies their value by their financial management and their financial statements. And then companies that come in and aren't so prepared and want to exit later on and see their value of their companies kind of deteriorated by not having that. We should get a lot of value from kind of those different perspectives today, which I've really tried to put into this presentation. So the poll question that I had here was, how many of you believe that you are responsible for the financial management of your company? And then we could just give that a moment. Oh, and do we have that result? Yep. So 94%, which makes sense. To be honest with you, everybody in a company is responsible for the financial management of the company in some regard, whether you're in sales, whether you're answering the phones, there's customer service, everything alludes to the end result, which is either going to be a profitable business or a not profitable one, as every little stepping stone is going to make a difference in that business's performance and ultimately whether that business makes it or not. And today's workshop hopefully will make it so we can make better business decisions based on that financial performance, which trickles down into every aspect of a business. Take a look at this slide here. This is everything that we hope to accomplish in this website, or not the website, webinar. As you can see, there is a lot which we want to kind of go through today. Go ahead and write down anything that you may feel that you have gaps in and want to pay particular attention to. Again, a lot of what we'll be covering today might be more of a 30,000-foot view. However, we do want to make sure we have practical knowledge in all of these things and all of these areas, and that we cover a little bit of everything that is here on this slide. By the time we finish, I want to make sure that you can understand financial statements well enough to have an intelligent conversation with your banker, your CPA, any investor that walks through the door. And that's going to be in a powerful powerful place to be with any advisor, or any, spouse or anything. So you know that you really have a handle on the finance of your business. One more thing that I want you to hear, that none of this is going to be complicated. Um, it's it's not as complicated as a lot of people make things out to be from the outside. And so financials and financial management really shouldn't be scary. So we definitely want to break that down today. And that's what today is all about. I want to start by talking about something that's often overlooked in a small business, and that's the advisory team. Most of us, when we think about a business, especially if we're looking at a small business, it's mostly a solo endeavor. You had the idea, you took the risk, you started the business. So a lot of the business you feel like is all on you. But these are the important team members that you really need on your side to have your back and to support you in the business as well. Your attorney handles the contracts, the entity structure, the liability protection, the employment matters. You want them to be there to figure out the legal side of a problem before you actually have a problem to be handled. Your banker doesn't just handle deposits for you at the bank. You want to make sure that that's a close relationship that helps you to scale your business in the future. A good CPA can help you to grow your business, to scale your business, to find opportunities for growth, not just find ways to save money at the end of the year. Risk manager is your insurance agent. We'll talk about this a little bit more in the future, but a good insurance agent can actually help you to grow your business, not just protect the downside risk that honestly can take your business away from you at any moment. And then your score mentor actually sits at the foundational corner in this diagram for a reason, because they're the connector that can help you to expose where you don't have all these team members in place and where you may be lacking, and kind of point out where your business may have an opportunity to grow further. So some of the benefits of financial management that we're going to cover is it's your main avenues to success. It can point you to different ways to make a profit. It really helps in your decision making, and it helps you to set your prices for your services, because if your cost of goods are going up and your margins are getting smaller and you don't realize it, then before you know it, it's costing you more to provide your services than you charge for them, and your profit is just going out the window and you don't really know. But with with good financial management, it provides you with the tools in order to plan. There are four different things. So first, it gives you the a true read on your profitability, and not just collecting money, that you're actually making money, and they're not the same thing. Second, it gives you decision-making power. Third, it helps you to set your prices. Fourth, it gives you the planning tools. And fifth, and this is the one that most people don't even realize that they need, it's the sound financial management that gets you funded. Um, Banks, which we'll talk about in a little bit, which I have some experience as well, can also help you to recognize opportunities for scalability, for growth, for acquisition, and things like that in the future, which may point to opportunities you didn't even realize that you had. Let's first talk about budgeting, because it's a foundation of everything in a healthy financial management practice. A budget is simply a written plan for how money moves through a business. Really, that's as simple as it gets. Um, So here's what a budget actually does for you. It tracks all your expenses, but not just the big ones, but all of them, the small ones down to every little category. A lot of business owners, they treat profit like a bonus, what's left over at the end. And that's completely backwards, because profit is not what's left over, it's what you plan for. Um, it should be your guide to growth, and it should be liberating, not restrictive. So when you build a budget, you're actually declaring what your financial future is going to look like. So here's the practical power of a budget. Once you build it and you use it every month and you compare it with what you planned versus what actually happened, those variances, that can point you in the direction of where you need to make differences and where your business can grow in different ways. However, I want to point you to something that I consider a little bit easier than just a line by line budget, which can feel restrictive, like a restrictive diet that most people give up on after 30 days. So this is a framework that I call the conscious spending plan. I find it far more useful than a traditional budget because it's conscious. It allows you more freedom. It tells you what you can spend rather than what you can't spend. Conscious spending plan works in the opposite way than a traditional budget. You start with just three categories and you categorize all your expenses by one of these three categories. Productive spending is what creates actually value in your business. It generates a return. It's an investment. You have investments, equipment, education, training, professional memberships, health expenses, all those things that keep you functional and moving forward in your business. So every dollar in this category actually works out to at least more than a dollar in return. So anything that you put into this, you want to increase. You can increase these expenses indefinitely because you're going to be increasing what's coming in revenue because you increase these expenses. So you can look at it this way. Um, by increasing these expenses, you're actually increasing your business revenue and your business profit, which is different than most people would consider for a budget. So productive expenses are those that you can actually increase, and you want those. Those are the good items. Consumptive expenses are not necessarily bad. However, they're not really productive. They're the entertainment, the lifestyle upgrades, they're the splurges, the things that make your business not necessarily worth it, but just more enjoyable all around, which can be almost on the borderline of those productive, but these you want to make sure are in check and budgeted for. So these are the things you want to kind of keep your eye on and just make sure that they're in check and in line. And you can have a guilt-free account for these in particular. And if you find they're making you more productive, then you can move them over to the productive side. But consumptive spending, those are the ones that you actually budget for. Now, destructive expenses are the ones that really don't do anything for your business. So these are the ones that you want to cross off and get rid of immediately. This is high interest debt, unnecessary penalties for fees, subscriptions that are never used, reactive overspending, really anything that is not contributing to your business and that you don't need. These you get rid of. These are the destructive expenses. So if you immediately just feel like you can get a handle on these three expenses first and foremost, you'll be in a much better place to look at your budget and know what's actually going on in the spending of your budget. The power of this framework is it creates awareness without creating any kind of shame. Most business owners, when they actually look at the spending for the first time, they can find thousands of dollars in destructive and consumptive spending that can be redirected into the productive category that can make their business much more powerful. The other thing to kind of look at before you look at kind of the line by line budgeting is to make sure that what you're paying for is valuable. A lot of times when somebody's shopping for something, they'll do a request for proposal and they'll look for just the cheapest price on things. But you really need to consider, especially in a business, that price is not the end all be all that you need to be looking at because the cheapest price on something could actually cost you the most. So price is what you pay at the register. Price is the oftentimes kind of led by what something actually is paid for in bills, but that's not the actual cost because something can be low price and high cost. What I mean by that is if you buy a piece of equipment and breaks down for a week, that's going to be possibly a low price for the equipment, but a high cost because your company is going to be down and you're going to have to be paying for that. So low price and high cost there's riddled with examples of that. You need to kind of look at the the right way and the right order of making those determinations. And the right order of those things would be value and then cost and then price, backwards from the way people generally look at things. So price is what you pay at the register. It's a sticker number. It's honestly the least important of the three measures. It's always considered, but considered last. The mental trap of price first thinking is that it drives you towards promotions and discounts and deals. Classic example would be driving 15 minutes out of your way to save just a few cents on gas. By the time that you account for the time and the fuel that you burned to get there, you spent more than what you saved. Cost is the total economic impact of a purchase over its full life. So this is where most business owners, they leave money on the table because low price can mean extremely high cost. Again, because of the equipment example that I mentioned, that's cheap and unreliable. You have downtime, repairs, lost productivity, and the customer service problems that come from that can be extremely high cost. A cheap insurance policy is another example. If it leaves you unexposed, or if it leaves you exposed, it can cost you the entire business. So think cost is not just the acquisition cost. Value may be the hardest to quantify, but it really is the most important to lead with because value is the satisfaction, the peace of mind that you have that you don't have to worry about something breaking down and that you know you're running a reliable business. It's your competitive advantage. It's your relationship quality, it's your time saved, it's risk eliminated. When you buy from a vendor that you trust, even if it costs more, you're buying reliability, responsiveness, consistency, and those things have enormous real value that don't actually show up on an invoice. So the decision framework is simple. You start with value, then you evaluate the cost, then you look at the price in that order. When you lead with value, you make better purchasing decisions. Your business becomes more reliable, vendor relationships improve, and you stop chasing cheap solutions that actually create expensive problems in the future. So let's get specific, because knowing that you should manage your money well and actually doing so in a budget are very different. This is a banking structure, which I have realized that some of the most astute business owners follow in a way that helps them to manage their expenses without doing the line by line system, and actually being able to put money aside and protecting their business at the very same time. So I want to share with you this banking structure, and here's how it works. The operational savings account, it's your primary hub. Every dollar of revenue goes into an operational savings account first. This can be a money market fund, it can be a savings account, one or the other. It's not a spending account, it's not a checking account. It can earn a little bit of interest, which is a bonus or a cherry on top. But the important thing is that money is going in and it's a saving. It's an account that holds your money. It's not meant to go out from there. From there, you're going to have two separate accounts which go to the owner's equity, or the business owner from there. And that's your wealth capture account or your living wealthy account. That's your war chest and your guilt-free spending accounts, respectively. With a wealth capture account, that's going to cover 3% for your inflation buffer that we all know is every year. And then it's also going to be 3% for planned obsolescence, because we know that things just get older and break down over time. It's going to have 3% for technology updates, because even homeless people have cell phones nowadays. So we know that technology is going to increase. And so your business technologies are going to have to increase with those. And then 3% for lifestyle growth and things like that, because we know every year you're going to want to account for that too. So if 12% goes to your wealth capture account and your war chest account to account for those increases, you know that you're putting that money aside. Now, your living wealthy, guilt-free spending account, this can also be for your business. This 3% from this total 15% that you're taking off the top, this is discretionary spending for the business with zero guilt. This can be for, the bonus trip for sales incentives. This can be for nice gifts, a Christmas party. This can be for really anything that you want to have guilt-free spending to give back to the business, or for the atmosphere or the culture of the business. Goes into this account. This is completely consumptive spending, and it's completely okay, and you don't have to worry about it because you put it there for that reason. These other two accounts, the vendor account and the payroll account, is very important that you keep separate from the operational savings account, because most business breaches in their banking system occur when somebody gets a routing number, an account number, when you pay a vendor that is disgruntled, or somebody doesn't dispose of a check the right way. After you pay a vendor. A vendor check can go through 200 employees when it goes through an accounts receivable department at a large company. So a number of people can kind of intercept that and get that account number and that routing number, or copy the check. Or if it's not disposed of correctly, it can be recashed and put through for different amounts. And if that's attached to your operational savings account, you put your entire business at risk. So you want to make sure that you have just-in-time payments for your vendors as well as your payroll. If you don't go through a payroll company like Paychex that has their own account number and routing number, you want to have a separate bank account for this as well. For the vendor accounts, I actually suggest telling your vendors that you pay twice a month, just like you pay twice a month for your payroll, and have those on alternating weeks. The other benefit to doing this is you can look at your monthly spending and you can see anomalies as they happen, because you get used to, my vendors are generally this and my payroll is usually this on a regular basis. And so every month should resemble each other, and you'll be able to spot those anomalies and explain those, which we'll get into a little bit in the future. If you get nothing else from today, though, I highly, highly recommend make sure that you are separating your operational revenue that's coming in into an operational savings account and separating your vendor and your payroll payments. So you're not just working out of one checking account, so you can protect your business. Um, and if you can, and if we can work up to get to that 15% number, and if you're not there yet, work up to that number to make sure that you're capturing for your war chest in the future for scalability, that 12% and that 3% off the top when those things come in. Let me show you this. Should break it down a little bit more clearly as far as what this actually looks like. As revenue comes in, it goes into your operational savings account or money market account. And then from there, it's swept over. Your 15% then is broken into your two accounts for your business to put aside that 15% for your wealth capture and your living wealthy. And then the other two accounts are just in-time payments for your vendors and for your payment and your payroll. Some people do this on the weekly basis. I recommend on a weekly cadence, and you can have it set it up to do this automatically. I suggest having the 15% done automatically. And then if you want control, you can also do the manually. Make sure just in time you know what your vendor payments are, and you can double check those on a weekly basis. If you make all your payments on Fridays, tell your vendors you pay every other Friday, tell your payroll that it comes out every other Friday, and then you can kind of keep an eye on those bills as well, which helps you manage your cost in your business.
Hey, Brian, you mentioned 50% there. What exactly were you referencing when in the last slide you had?
The
50% of what?
15%. So 15% of whatever comes in. So whatever comes in as far as revenue gets swept over. 12% of that goes into your war chest to cover all of those increasing expenses. And then 3% of that is completely consumptive spending.
Gotcha.
Um,
Yeah, I thought you said 50%, but it's
no,
15. So got it.
15.
Okay.
Yep.
Thank you. Thank you for
Yep.
clarifying.
Yep. Yeah. 12%. There's 3% for all those categories, and then the 3%. And then this, hopefully your operation and whatever's left in the operational savings account then is for your regular business expenses and kind of what's left from there. Okay. Bookkeeping. So bookkeeping really, so we've kind of mentioned obviously the budgeting and labeling your expenses, getting rid of the destructive expenses, leading with value, and setting up a bank account that's putting aside money for you in the future, as well as protecting, having a structure that actually protects that operational savings. But you still need to know what is coming in and going out. There is bookkeeping software like QuickBooks, which I use, and I know Matt would be an advocate for, but there's a number of software out there at every price point available, including free. So there's QuickBooks, there's Xero, there's Wave, there's a lot of great options. And if you have regular expenses and you label what those are, it can recognize them as they come in, which makes it a lot easier than, kind of the old pen and paper method. So number one is obtaining accounting software, opening up a checking account. And I think we've already, mentioned you should have a savings account first and then the checking accounts for exact reasons, which also does allow you to separate things from your sales and what's going in and what's going out. By doing these things, by separating these things, it also does help you to classify things and keep an eye on those things just by having the separate accounts as well. So paying business expenses first. I think you need to pay yourself first, which is that 15% as well, and then run a P&L and pay yourself. I think the pay yourself, which again, most business owners they leave that for the last bit. And I guess to make a point on this, if you ever want to build a valuable business in order to sell, that pay yourself first aspect, it's going to be your most valuable aspect because people are always going to be looking for cash flow and what somebody can get out of the business for a new owner rather than what's left. And so anytime that you're just paying yourself with what's last, kind of on the list, you're deteriorating the value of your business. So kind of keep that in mind as well. Um, so make sure that you kind of are putting that top of mind for that reason. So something to keep in mind on bookkeeping. There are two methods of bookkeeping. There's the cash basis, where um, you're recording everything as it comes in. So it models the cash like it's going in and out of your bank account. And then there's the accrual basis. So cash basis accounting, it's simpler of the two. Under this method, income's recorded when you receive a payment. Expenses are recorded when you actually pay them. If a customer owes you $5,000 but hasn't been paid yet, the money doesn't show up in your books. If you have a supplier that you invoice, and the invoice is due next month, it's not shown up as an expense yet. It's really straightforward. It's really intuitive because again, you can kind of look at your bank account and see what's going on with literally the cash, but it doesn't really tell you what's going on in the activity of your business. Accrual basis accounting tells you more what's going on in the business, but it doesn't tell you what's going on with the cash. So, for instance, when you deliver a product or service, the expense is recorded as it incurs because it's the activity of the business. When you receive uh, goods or services, regardless of when the cash changes hands, that's when you record it. So if you ship $50,000 in product this month and your customer has a 30-day payment terms, that $50,000 is shows up as revenue this month, even though you haven't been paid yet. So here's why this matters. Accrual-based accounting, it gives you a more accurate picture of the economic activity that's going on in your business, but it can create a dangerous illusion. Um, because you can look extremely profitable on accrual P&L while simultaneously running completely out of cash. This is one of the primary reasons that businesses appear to be doing really well and then not have the money to pay their bills. The IRS generally will require a business that has significant inventory to use accrual-based accounting. And the reason for this is because otherwise it will show a lot that they have the inventory, kind of sitting there, and it can be manipulated with the cash going in and out, and won't reflect their business. And they want to know what's really going on with the business, not what's going on with the cash. So for everyone else, cash base is usually simpler. It's still sufficient. What matters most is the consistency. So make sure that you're not going between cash and accrual basis to make things more confusing, and make sure that you understand which method your financial statements are in when you're going to read them. Um, so So now we're actually going to be getting into the heart of our subject matter today, which is the financial statements and actually managing your business by the financial statements. So I want to start with a real talk moment for just a moment, because most small business owners, they look at their financial statements only once a year, and that's when their accountant sends them to them. And at that point, they're really trying to do financial archaeology rather than financial management. Because they're trying to look at what happened rather than what could happen. So people in this room who start doing what we're talking about, we're going to have a measurable competitive advantage over those that are just kind of looking at what happened last year. So a complete set of financial statements for a small business has three core reports plus two optional ones. And they're two powerful supplements, but we're going to focus on the top ones today. Um, so we have the income statement, which is also called the P&L, or profit and loss. And it tells you whether the business is profitable. Did the revenues exceed expenses primarily? The balance sheet, which tells you what the business owes and what it owes. It's the financial snapshot in time. A statement of cash flows, which tells you exactly what happened to your cash, um, where it came from, where it went to. And then the other accounts are statements are the accounts receivable aging summary, which tells you how long that you're waiting on your accounts receivable, and your accounts payable aging summary, which is how long you are taking to pay your bills, which also does go into managing the cash flow. So, but obviously with today's subject matter, we have a lot to cover, but that is something obviously to take a look at a later date to help manage the cash flow of the business, and timing, because timing really does come play a major part in cash flow management of a business. Second poll question that we have today is raise your hand if you know when you can take a draw from your business, and we'll have that poll question come up. Every 2 weeks, once every 6 months, once a year, as long as it aligns with payroll or any time. What did everybody think? Oh, we had a mix. Okay. So every 2 weeks, once every 6 months, once a year. So the answer is actually anytime. So the a draw on a business is taking directly from the profitability of the business. It is your business, and you can take money from the business anytime that you like. Obviously, you want to make sure that it's there, which is why we're putting money off to the side. So, but I guess the tricky answer in that is really if you wanted to align it and have a schedule and have a plan for it, it could be any of those answers. So, anytime or E, all of the above would be the correct answer. But really having a plan for it, and we joked about it before this webinar began. Um, Probably the most incorrect answer would be just whenever the new iPhone comes out, So probably having a plan for it is the best response, not just as an impulse. Um, so as long as there's a plan and you know why you're taking that out and can kind of schedule that, and it looks reliable, and it doesn't look like you're using your business as a piggy bank, that's okay. Let's go line by line in an income statement. And so this is a picture of an income statement here. And the income statement is often the most misread. So revenue sits up top in that upper right-hand corner. It's the total amount that your business brought in from selling its products and services during a period. Simple enough. But notice that this is what you invoiced for the sales. It's not necessarily what you collected in cash. That distinction will become important when we get into the cash flow. Cost of sales, it's also called the cost of goods sold or COGS, is the direct cost of producing what you sold. For a product business, that's your materials, your manufacturing, your freight. For a service business, it's your direct labor charges. So you can have sometimes in your cost of service or um, goods here, you can have labor cost rather than wages. So if you have a restaurant, sometimes I've seen people put the staff wages and things like that in there um, if it's a service business. So direct labor, materials used to deliver the service. This number always goes with the revenue. So when the revenue goes up, the cost of sales typically goes with it. Your gross profit is the revenue minus the cost of sales, and this is your margin. So before you pay your overhead, your gross profit percentage, your gross profit divided by the revenue, it's the important metric for your business. It shows how efficiently that you're delivering your product or service. If your gross profit margin is shrinking, that's when you know that something has gone wrong. So either your pricing isn't keeping up with your cost or your cost are rising faster than your pricing. And that's why it's important to take a look at your income statement on a regular basis to make sure that first that's being kept in check and in line so your pricing is correct and adequate to cover the business first and foremost before your expenses. So your SG&A or your selling general and administrative expenses, it's everything else that it costs to run the business. So your rent, your utilities, your marketing, your management salaries, your technology, these are mostly fixed and they don't move with every sale. Um, because they're your fixed costs. They're not actually actively involved in the production of the product or service. And your operating profit is your gross profit minus your SG&A. So this is the profit from your core business operations. Net income, it's finally is what you actually earned after all your expenses. So your operating expenses, your interest, your taxes, everything. That is the famous bottom line, which sits on the bottom line of an income statement, which is why it's called the bottom line. So the most important single insight about a P&L is the net income is not your cash. And I can't say this strongly enough. A business showing $100,000 in net income may have significantly less or even a negative amount in their bank account. If you take only one thing from this section, take that. Your income statement is not your business. It's just a reflection of the activity of the business. Your P&L is a critical tool, but it's just one of the tools that we're going to look at today. You need to read it alongside the balance sheet and the cash flow statement in order to get the complete picture. So let's move on.
Hey, Brian,
Yep,
quick question.
sure.
Where would the iPhone that you plan for show up on your profit and loss statement?
Oh, on your expenses, I would put it under
Yeah,
technology.
it would be one of your business expenses. And okay,
Yep,
gotcha. Thank
yep.
you.
Yeah, it's not a cog because it's not,
Right.
it's not essential to those, but it would be your regular expenses. I mean, it is a business expense, so it'd just be a regular line item. Okay. So in this in this one, it's just going to be your under your operating expenses, so your general operating expenses. All right, and moving forward. Oh, sorry. So let's look at the balance sheet. The balance sheet is called a balance sheet because it always balances. Um, it's reflected of your assets equals your liabilities plus your equity in the business. Um, so it has three sections. They always balance, hence the name. Assets are everything that the business owes or is owed to have. So it's the current assets, which include your cash, your accounts receivable, your inventory are all assets. So things that will convert to cash within the year. Long-term assets would include your equipment, your vehicles, your real estate, any intellectual properties. Liabilities are everything that your business owes to others, like your accounts payable, your short-term loans, your accrued expenses, obligations due within a year. Long-term liabilities are loans and obligations that are due over the longer period, like a mortgage. Shareholders' equity, this is your owner's equity in the business. It's what's left over when you subtract all the liabilities from the assets. So it's the portion of the business that you actually owe or own. Um, is the equity. So this is your net worth of the business itself that you actually have ownership of. It includes the money that's originally invested in the business and any accumulated retained earnings over time and the current income of the business. So the way I look at this, that a lot of people kind of don't think about off the bat, but a lot of people understand when they get a loan for their house and they have a mortgage. Their mortgage is the asset, the liability is the mortgage, and the equity is the difference in their home equity line or how much they actually own of that mortgage as the asset of their house. So the percentage that they own of their house is the equity that they have in their house. Very, very similar situation, but a lot of people don't kind of think about that when they're looking at a balance sheet of a business. So when you put it in that term, it's the equity is how much, like owning home ownership, how much ownership you have of the business is the owner's equity. Very similar kind of way to put that. So the fundamental equation is always assets equal liabilities plus equity. If it doesn't balance, then something is wrong in the bookkeeping. So why does the balance sheet actually manage or matter in day-to-day management? Because it shows the leverage that you have and how much that your business is being financed by debt versus how much you actually own. It shows the liquidity that you actually have in the business. So your walk away, and it can and can you pay your bills in the short term? It shows the trajectory of the business and is the business actually growing or is it shrinking? Um, so a business with growing revenue but shrinking equity, it's a warning sign. A balance sheet will catch that before the P&L will. This is what a balance sheet then looks like. It's a real world example. Look at the example. Structure is always the same. Assets on one side, liabilities, and equity on the other. And the totals at the bottom, they'll always match, as I mentioned. So when you look at your own balance sheet, here are three questions that you should ask every time. First, is my current ratio healthy? That's the current assets divided by the current liabilities. A ratio above 1.5 generally means that you can pay your near-term obligations comfortably. Below one, it's a warning sign. Second, how much debt is the business relative to equity? Is it highly leveraged? If your liabilities are significantly higher than your equity, your business is leveraged, which means that it's a higher risk. You own a much smaller portion. If it will be harder to, it's going to be harder to get additional financing because you own less of your business itself. So, third is the equity growing from period to period. And growing equity means the business is accumulating value. It's growing. Shrinking equity despite positive net income usually means that the owner is drawing out more than the business is growing, and that's a warning sign if you need to take more from your business than what it's growing. Your accountant should be able to walk you through the balance sheet every quarter, and if they're not doing that, ask for it because it's an important conversation. Also, you should look at the 3-year comparison. You can pull this up on your QuickBooks report or your accounting software as well, and ask for your accountant for it if you're not getting it for your income statement. So here's what an income statement looks like when it's formatting for a comparison. So it shows the 3 years side by side. So this way you don't just look if you had a profitable year, you look at the trend. Is the gross profit percentage holding steady? Is it improving? Is it declining? Operating expenses growing faster than the revenue? Is the net income as a percentage of revenue expanding? Is it compressing? Those trends are what tells a story that any single year just can't. So a business with $2 million in revenue and 3% net margin, it's very different from a business with the same revenue and 12% net margin because both can show up on a single P&L and look just fine. The comparison also gives you benchmarks, it's important to know your industry benchmarks. An average net margin varies significant. They vary significantly by industry. So, for instance, a restaurant at a 5% net margin, it's doing great. A software company, however, with a 5% has a very serious problem because their expenses look completely different. So, know your industry benchmarks. Your score mentor can also help you find them and talk to you about these. And it always helps to have the income statement side by side. So hopefully people are using the multi-year comparison reports. And if not, I suggest that you either, like I said, pull them from your QuickBooks report or ask for a P&L side by side. It usually costs nothing, but it changes everything with how you read your numbers about how your business is actually doing year to year. Right, so actually using these financial statements to manage your business. Now we're getting into what I believe is one of the most important of the financial statements, and that's the statement of cash flows. The cash flow statement tells you just one thing, and that's what actually happened to the cash. Not your profit, not your revenue, not your accounts receivable, not your actual the activity of the income statement, but your actual real spendable cash, how much came in and how much went out and how much remains in your bank. There's 4 reasons that cash flow is confusing, and I'm going to name all 4 so you're not alone. Number 1 is profit is not cash flow. It's the single biggest source of confusion in all of small business finance. You can show a profitable P&L and run out of cash. It's actually the number 1 reason that small businesses fail is they run out of cash. They fail not for lack of profit, but from lack of cash. We're going to prove this and to you in just a couple moments. Number 2, there is no single cash flow number. Profit is one number on one report. Cash flows is just a set of changes. It's a story. It has to be understood as a story, not a number. Number 3, an increase in cash is not always good, and a decrease is not always bad. So if cash went down because you invested in new equipment that will generate $200,000 in revenue over the next 3 years, I mean, that's a great use of cash. But if cash went up because you stopped paying your vendors, I mean, that's a very bad sign. So number 4, the way accountants present cash flow, it can really be confusing. The statement of cash flow itself, it's from most accounting systems, it's a very dense multi-page document. It has 20 or more lines on it. Most owners look at it, they feel overwhelmed. They look at the bottom number and they think they got something from it and they throw it out. There's a much better way, which I am going to show you on the next 2 slides. Now, this is what even a condensed cash flow statement looks like. But if you count the lines, there's still over 20 lines here, and every one of them represents a category of cash movement in the business. Now, ask yourself, if I handed you even this report to, most business owners, unless they study finance, what would they do with it? I mean, most would honestly, they look at that final number, the net cash flow, and they move on and they'd miss everything in between. But on a cash flow statement, it's the everything in between where the insights are. The bottom number is meaningless. Um, so this is why the next tool that we're going to show you is so valuable. It takes this 20 plus line report and it boils it down to just three things that actually drove your cash flow position month to month. Just three things in plain English. And it makes it so you can actually explain what's going on in your business in a 2 minute conversation to your banker, to your accountant, to your partner. Um, so the full cash flow statement, it's not useless. You should still look at it, but you want to have a better understanding of it. Your accountant still should produce it, but you don't want to study every line. You really just need to know the biggest drivers in your business and understand those. And the cash flow focus report does exactly that. So let's go into how to produce a cash flow focus report from a cash flow statement or a general ledger. So with a cash flow focus report, which will focus just on the main drivers of the cash flow so you can understand them in your business, um, it's going to answer just one question. What happened to your cash last month? Einstein said, if you can't explain something simply, you don't understand it well enough. So the cash flow focus report really forces you to understand cash simply enough in order to explain it in a 2 minute conversation. And that's not dumbing it down. That's genuine understanding. Here's how it works. You need 10 minutes just once a month, and you need to follow just 4 steps. Step one, you enter the cash balances and you round them to the nearest thousand. So you don't worry about the cents. So you can make the numbers look a lot smaller. And if you're looking at hundreds, you can make them even look smaller than that. But the point is, you don't need to look at big numbers. You really just want to understand the context of the movement. So you can work with manageable numbers. It's about, big picture. So you pull out the your cash flow statement, so your accounting statement or your general ledger, and you really just you circle the three largest movers. And by that I mean your either largest gains or largest negative numbers. The three biggest changes in the cash flow for the month. And that's it. Just circle those three. And then you just write one sentence what that was for, what that big change was for, what made that big change occur. And then step four is you're going to label whether that big change that you just wrote that one sentence, because now you understand it, was that good or bad? And that's really it. Like I said, it shouldn't take you more than 10 minutes. You just skim through your general ledger, you skim through your cash flow. Um, you skip through here, you look for the biggest changes, your biggest movers, your money spent, your money that came out, your money in, your money out, your largest ones, and then you write a sentence about what it meant, and then you write whether it's good or bad. You could put this on an index card. Just do this once a month. Okay, and then I'm going to show you what this looks like. Here is, and you can you will get a copy of this slide, so you can kind of copy this format and use this on your own because it's not complicated. Again, it can fit on an index card. What you're going to do is you're going to write down the beginning cash and the ending cash. So here's your beginning cash and here's your ending cash. So you know that from your cash flow statement or your general ledger. And now you are going to have your numbers in the middle. I just need to move this. So in this is again broken down by thousands. So you had 32,000 in sales that went up. Sales went up by 32,000. So you put that there. You write your one sentence here. Obviously, sales are good. It's nice that sales went up by 32,000. So you write good. You also had accounts receivable. You had large orders shipped on credit, right? So this that you sold all shipped, but you're not going to get paid until next month. So, which means you had to pay for them first. So this is negative 46,000. So that made your cash balance go down by 46,000. But that's still good because they shipped on credit. You're going to get paid for it next month. So that's still good. Your accounts payable came in that you got 18,000. So the vendor invoices were entered but paid after the month end. So that's money that came in from last month, but that's good, right? And those are your three biggest changes. right? Now you can explain in our sentence at the bottom that we made money this month, but cash dropped by 6,000. How do you explain that? Because the large order is shipped on credit. Cash comes in next month. Vendor invoices were entered but paid after month end, and we expect next month the timing to be reversed. So that can help you to explain what happened and why, even though you had large sales come in, that your cash balance actually in the bank went down, even though you're making good money and you had sales. So um, hopefully this helps. Does anybody else kind of recognize this pattern in their own business where profitable months actually show that they lost cash? And this really helps you put a kind of put a peg on what's going on not only this month and not only last month, but what's going to happen next month. Because now you know what to anticipate for next month, because now you know that the large order was shipped on credit and the cash is going to be received next month. So you can kind of anticipate already what next month's cash flow focus report is going to look like. We did skip one um, item from the profit from the P&L statement. So just to kind of go back to that really quickly here. The um, the P&L measures the profitability over a specific period. But here's how to make it generally useful rather than just a number to hand your accountant. First, you read it line by line, not just the bottom line. So similar to what we're doing with the cash flow focus report and knowing what's going on, net income might be the result, but you do want to kind of look at it very similarly and know the story of the components. So a business with healthy revenue and good gross margin, but an expanding SG&A has a very different problem than a business with a flat revenue and compressing gross margins. So you kind of want to know the story behind it. Second, compare it to your prior periods, month over month, quarter over quarter, year over year, so you can kind of tell the story of what's going on in the business. Third, compare it to your budget. So this, if you look back at the categories that we talked about and you line your P&L with your budget, you can know what expense categories might be running over. If those productive expenses really are as productive as you think they are, or whether they're more consumptive or destructive. And fourth, you know your key ratios. So you really want to make sure you have a handle on your gross margin percentage. And it should always be relatively stable. It shouldn't be moving back and forth. Your gross margin and your COGS should be kind of in line with what you expect. So, and fifth, pay attention to your revenue quality. Not all revenue is created equal. So you want to pay attention to where your revenue is actually coming in. So high margin services count more than high volume. Low margin products um, aren't counted as high because you have to work harder to get those. So revenue from recurring customers obviously is a lot more valuable than revenue from just one-time transaction that you can't count on coming back in the door. So the P&L shows you the total revenue, but you also have to think about the composition and how strong that P&L actually is in your business and how strong that actually makes your business as well. And then I do have one third poll question here, which we should be able to answer pretty readily after the cash flow focus report. But answer the question, can you show a profit without having cash? It's a
Yeah.
yes or no.
Brian, Gwen needed to leave, and I do not have the ability to launch that. So maybe
And
they could just enter their
yeah,
responses in chat or raise their hand or something.
yeah,
So,
and I'm pretty sure. Hopefully, we've hammered that. If you have one big takeaway from this financial management, it is that cash is not the same as profit. And yes, you need to keep an eye on the cash, not just the statements. So you need to put those together. You can run out of cash and still be profitable. So now we'll run to the other side, and that's business financing. Oops, sorry. And how are we doing on time? I don't have a clock. Okay. Okay. Um, so now we move to the other side, which is business financing. So there's four categories of business financing. It's important to understand all four because they have four different purposes. Equity financing is invested capital. It stays with the business permanently, or at least for a long time. Most small businesses, equity comes from the owner's personal savings, family, occasionally investors. Advantage is there's no payment obligation. Trade-off is that you're giving a portion of your ownership in exchange for somebody else having that equity. Um, so debt financing, it's the borrowed money for your business that you'll repay with interest. Example is your term loans, equipment financing, SBA loans. Advantage is you retain the full ownership of your business minus the lended amount. So your cost is the interest payments and the obligation to repay regardless of the business performance. Working capital is a financing that's specifically designed for day-to-day operations of the business. And your fixed asset financing, it's used to purchase equipment, vehicles, real estate, other long-term assets. What's important here is understanding which type of financing you need for which purpose. It's the most common places that small business owners make a mistake. It's you want to make sure that you're funding long-term capital purchases with long-term loans, and short-term lines of credits need to be on a cash flow basis rather than um, so short-term loans for short-term purposes, long-term loans for long-term. If you get those backwards or mixed up, it can cause cash flow mistakes and very expensive financing decisions. So just to kind of mention the loan process here, it's always good to have a business plan. Um, a lot of times, the single most important thing that you can do to improve your chances of getting a loan is just to be prepared before you need one. Not a week before and not a month before, but just now, always be prepared. Start with a business plan. You don't need a 40-page document. Just you need a clear articulation of your business and what you need the money for and how you're going to repay it. So know what you can afford, run your numbers, have an idea of your debt service, have some skin in the game, study your financials as we're talking about today. So you're going to have a significant head start above others if you understand these things we're talking about today. Check your credit. Your personal credit, especially in small business, will be tied to business loans at this point. Everybody asks for a personal guarantee right now, and they will look at your personal credit. I was talking to somebody earlier today. The bar has raised up from having kind of the standard minimum of 640 to 680 before you apply to anything. You want to make sure that your credit score is at least above that 680 credit score. There are ways to, get that up. Check your, make sure there's no negatives on your credit report. If you need to dispute your negatives, send disputes in writing around the holidays. Any credit bureau has 30 days to correct those, and they always have 30 days, whether there's holidays or not. Also, another way on the credit side, on the personal credit side, especially, is it doesn't matter whether you pay down your credit or whether you increase your credit utilization. Credit utilization is 35% of anybody's personal credit score. So if you add more credit to your revolving credit bucket, which is the larger percentage that people are looking at, it's really the same as paying down credit cards that you might already have. So if every 6 months you ask for additional credit to the credit cards that you already have, you can increase the credit that you have available to you. It'll be just the same as making that amount of a payment towards the credit that you already have on your card. So that's a simple way to kind of always be increasing your credit score as well. So kind of keep that in mind. Not to get off on a tangent there, but yeah, people's personal credit does make a difference. Let's see. To understand your collateral. So know that somebody is going to want to know what your equipment is worth, what your real estate is worth, what your inventory is worth, just as kind of a backup. So, and you'll want to show that you are also putting in money. No bank wants to see that that you're going to them exclusively and you're not going to be putting your own finance into an expansion project. They're generally going to be looking for 10 to 30%, whether you're making an acquisition of a new company, whether you're buying new parts, or whether you're just looking to grow your company in some way. You'll want to be able to show that you're also putting money into a project that you're looking for a loan for. So there's three ways to finance operations. That's personal credit lines, business lines of credit, and business term loans. Personal lines of credit, although you can use personal credit services, personal credit cards, things like that. Important thing is here, never commingle. You expose yourself personally. You expose your family. You expose things and create tax nightmares. So if you use personal lines of credits or a personal credit card, never ever use that same credit card for for personal uses. At that point, it needs to become a business credit card with your personal name on it. Um, it's the easiest to access, also can be more expensive than business credit cards. So you kind of want to look at that too. But also the promotions can sometimes be better. So you want to kind of compare that. So mixing, it says here, never mix it, obviously never mix personal and business finances. It creates bookkeeping complexity, potential legal liabilities. So again, if you use that, you can use it as a bridge. Can just consider kind of what you're doing there. Business lines of credit are revolving credit facilities where you borrow just as you need it, pay it back. These are for short-term purposes only, for inventory gaps, timing differences between receivables and payables, seasonal fluctuations. They're never designed for long-term. If it becomes a permanent loan in disguise, it means that you're using short-term financing for long-term need and you're really overpaying. So business term loans are a fixed amount for a fixed rate, fixed payment over a defined um, term, typically structured as an asset being the finance. Equipment loans, vehicle loans, commercial real estate loans, and term loans. The payment schedule is the life of the asset that's being paid for. So a 5-year loan on a 10-year piece of equipment, that makes sense. A 5-year loan on a 2-year piece of equipment does not. And that's where you kind of want to reevaluate how long you've been paying on a credit card and what it was used for, or how long you've been paying on equipment and things like that. Because if the loan does not line up with the life of what you were paying for, you're paying too much. And you may want to look at ways to refinance and speak to your banker about that. So what actually lenders look for in evaluating a loan application? We mentioned the good credit score. That's both personally and business. If you haven't started your business credit file yet, you can go to dnb.org, I believe, and start your business credit file. And you can also see some of the vendors and things like that that report and build business credit. Two business credit reporting agencies are Experian and DNB. And DNB lets you start your own profile for free with the what's reported, so you can at least start building that with some of your vendors. Equity contribution, again, they're going to look for skin in the game. Your repayment ability, you need to make sure that your debt service coverage, for every dollar that you borrow, you need to make sure that you have at least $1.25 coming in operating income, and your loan to value ratio. So your loan to value ratio applies from asset-based loans. So most companies or banks will lend 70, 90% of the appraised value of an asset. You can get an appraisal for the value of an asset, and you can generally get a loan on that asset after a certified valuation of 70, 90%. The remaining 10 to 30% needs to be your own equity injection, and that is also then used as their collateral on the loan. SBA loans. So a lot of people don't realize that the SBA is not a lending organization. They just provide insurance to the banks so they will guarantee the banks the loan, which allows the banks to feel a little bit more comfortable making a loan. But the lending institution, the bank themselves, are following their own protocols to make the loan. But if something goes wrong with it, they have the insurance of the Small Business Administration for the SBA loans themselves. And you can find SBA loans at most credit unions and banks. There is a difference between a preferred lender and a bank that just offers SBA loans. So you want to ask if they're a preferred lender or not. It also will make a big difference in the amount of time to actually write an SBA loan. If it's a non-preferred lender, they actually need to go and ask for approval for every aspect of the SBA loan as it is being submitted, when a preferred lender will just follow their own protocols and the bank and then submit it for final written authorization from the SBA at the end. So there's a big difference in just offering an SBA loan and being a preferred lender with the SBA. So we are finally getting to putting everything together. We've covered a ton of ground today. So I'll give you the summary versions with 5 statements here. So financing is getting the money that you need to start, operate, and grow your business before you borrow build a plan that shows how you're going to use the money to repay it and shop your options, matching financing with the length of time for its purpose. Budgeting is a foundation for financial management. It's not restrictive, it's just a plan. A conscious spending plan helps you to classify every dollar as productive, consumptive, or destructive. Five dedicated accounts protect your cash and eliminate your financial chaos. Bookkeeping is the record of everything that happens financially in your business. It has to be consistent. It must be current on a regular basis. Otherwise, you'll get behind and can't keep up with it. Um, so it's a lot easier just to do it on a monthly basis. It must be separate from your personal finances at all times. Good bookkeeping is what makes good financial statements possible. Cash flow projections will show you financial trouble before it arrives, not after. They'll help you to plan slow sessions, time major purchases, and have informed conversations with lenders or your spouse. And combined with the cash flow focus report, they give you genuine confidence about where your cash is going in the business and what your business is doing. A profit and loss statement is your monthly report card on your business performance. It shows you your revenue, your expenses, your profit. But remember, profit is not cash. Read it monthly, compare it to your prior periods and to your budget, and use it to make your decisions, not just as a report of your history. If you build an advisory team, practice these financial disciplines consistently, and use your financial statements as live management tools, not historical artifacts as most businesses do, you'll be in the top tier of financially managed small businesses in this region. Not exaggeration. Most businesses don't do this at all. So you're going to be different. So before I go, I want to leave you with something more than just a list of topics that we covered. Running a small business is one of the most meaningful things that a person can do. You create jobs, you build something from nothing, you took on the risk that most people wouldn't even ever consider. And on the financial side of it, the part that we've talked about today, at least, it's really not the boring part. It's the language that tells whether the risk taking has a reward to it, and we'll have more rewards in the future. The business owner who masters this language can read their numbers, explain their cash position, have intelligent conversation with bankers, and build financial system to protect what they've created. Those owners, they're going to sleep better at night. They're going to make better decisions under pressure, and they're going to survive the downturns that take their businesses out. So here's what I'd like you to do in the next 7 days. And these are just three things moving from here. One, request a score mentor. Um, Process takes just 5 minutes. First, your meetings are always going to be free. There's always going to be somebody there to help you along the way with these things. Two, print out your most recent cash flow statements from your accounting statement or your G&L, and sit down with it and try and build your first cash flow focus report. See how easy it can be. Find the three biggest line items, write that one sentence and whether it's good or bad. Look at your bank structure. Go to the bank, talk to a banker. Find a good banker. If you don't have a good banker, talk to a score mentor, see if he can connect you with the banker, and separate your operating reserves to make sure that your business is actually protected. These three actions, if done in the next 7 days, it'll be a measurable impact on your financial clarity. And your financial clarity, it's a foundation for everything. So we have a couple of moments still left, I believe, for Q&A.
Yep. Yeah. Actually, I have three questions.
Sure.
One is, do you have advice to modify the budget account structure for retail businesses? Most revenue coming in pivots directly out of payroll and vendors to purchase inventory.
Yeah. Yeah. So your inventory should be your vendor account. Your payroll and your vendor. Honestly, that is set up. So when I had my vending company, which is still a retail type of business, it was set up exactly that way. Um,
Okay.
and I had to negotiate. I understand that yeah, it was a asking people to only pay them twice a month. Wasn't an easy conversation, but I was able to do it for most, not all.
Okay.
And even if you can't pay twice a month, just make sure you have a separate account to pay for the inventory, and that is your vendor account.
Okay. So this is from Laura. Are we to pay ourselves first or the business expenses? Both were mentioned.
Hmm. So I think you should have if you can, and I know it's not easy to get there, um, but I would try first and foremost to have that wealth capture account and to have um, that living wealthy or that free spending account. If you need to cut that down, to 10% at the top, and do 7% and 3%, so you're cutting that first war chest and then build that up to be the 12%. I would do that. But you want to take the money out for yourself from the top.
Okay.
Now, the money that is being set aside is also, you have to realize, being set aside for a reason. So the money is there when you need it.
Demarius has a question. A couple slides ago, I think when you were talking about setting up a credit, your personal credit or situation, was it BMV or DMV.org?
It's sorry, done in Bradstreet. I apologize. You can do a search, a Google search for Dun and Bradstreet.
Okay.
Yeah.
Okay. So it's
And then create a business profile with Dun and Bradstreet.
okay. So that's DMV dot
D done.
D
Yeah.
one more time.
D is in dog.
MV dot
N
org.
and B Bradstreet.
Okay. 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 Got it. Got it. Okay. You mentioned a vending business. We are looking to start Demarius is actually looking to start a vending machine business. I think he wants to talk offline, but I think do you have your contact information on a slide, Brian?
Yeah, I actually don't.
Okay. Okay.
But I
You
can
want
put
me
that in
to,
chat. Yeah, here we
yeah,
can
put
put
it
that
in
in chat, right?
chat. Yeah. And for everyone that's still on, you will receive a copy of Brian's PowerPoint. And we will be posting the recording of this on our website, which is score.org forward slash Akron Canton. And it will be there probably by the end of the week, I'm guessing. It's not something we do automatically. So with that, Brian, I want to thank you for sharing your. Wow, it's a wealth of information. It's almost overpowering. If anything, it'll hopefully some of you will go to our website and request a mentor. It's very easy, and we can answer those types of questions. So, with that, I'm going to say so long. Everybody have a good week. Thanks, Brian, again.
Okay. Thank you all.